filled on daily profit play down here. So open, open. We were filled for a daily profit play here, and shortly after, um, nice profit. So pretty good day overall. It stayed within the levels for our trade if anybody held it longer, but we took a nice profit overall. That was a nice win. I'm enjoying those. I'm sure you are as well. It's nice to take a win and get paid within, an hour or two. So we will refresh. Let's go 68.50. Prices are opening lower. We're going to probably have a decent sized gap today. So let's go 68.50 with the close. VIX is up towards 18 this morning. Let's go 5 minute there. Okay, VIX is 18.21. So right now, looking about a 1.14% move, possibly more. Gamma read on the morning, positive negative gamma pivot at 68.45. If we are opening below that, which with the gap, I'm sure we will be. So close 0.3 to 0.4% gap. We're going to open up in negative gamma. So again, not that doesn't dictate anything for the day. It's just if the market wants to come back into positive gamma, okay, fine. We know what that looks like. That should be a rally. But if we're opening right around the 68.25, question now is, will it be dropping lower towards like 68.10, 6800 on the day? Okay, with the gap, I'll calculate a pretty conservative bottom. I'll take the gap lower plus the VIX box and see, as long as the VIX isn't going to blast off to like 20, 21, 22 on the day or worse, just make sure you're updating those calculations, right? If you want to, do a bear put spread like a debit spread, or rather call the bottom with a bull put spread, or you're looking to buy the bottom with a bull call spread, just calculate out the VIX. So if we're going from 18.22 VIX right now to in an hour later, let's say we're up to 19 VIX, then recalculate it, right? Just a little bit more movement expected. So 18.25, oops, 18.25 divided by 16. So about a 1.14% move. This is why I built the daily profit play indicator. So we're centered. We're going to gap lower, take the gap, stretch that VIX box measurement, and then we have some gamma levels today to watch. Pivot point 68.45, possible support around 68.25, which is where we may open this morning. So if we open, try to fill the gap, open, chop around. It's Thursday. Markets reopened. We didn't have any news this morning. I think everything that was tentative still didn't print. So today's CPI news, non-existent. Taken off the calendar. Wasn't ready to be shown. I put this in Telegram yesterday. I posted a video, TradingView, YouTube, all my socials. Hopefully you had a chance to check it out. Right here. So simple majority passed. Government reopened effective immediately. I know there's some, short-term funding, I think until like January 30th. Short-term funding for the government. Big thing was healthcare and SNAP benefits. So majority was needed. I think they got it. The government's reopened. See what price does so far, opening negatively with the futures market to the downside. Gold is up, silver's up, Bitcoin is up as well slightly. Inflation was due today. Producer price index due tomorrow. I don't think either one are happening. I don't think either one will print. And we'll go another week with no data. I didn't talk about this yesterday, but I mentioned that my third party readings. This is my kind of third party website that I look at quite a bit. Truflation. So I think this is actually more government. That's crazy. Offline. This to me is more accurate than what we're getting. I think that there is a suppressed inflation reading from CPI and PPI. Obviously, we're not getting it right now, but anytime this has been trending, okay, so this is the 1 year out. Um, yeah, I'm not gonna upgrade. Uh, we were stuck for a while in this window, and I was pretty confident. Okay, like inflation wouldn't do much, but as we started to tick higher in August, September, October, now November, we are clearly seeing that the trend is slightly higher. Now, does this mean we go from 3% headline inflation to 3.5? No, but probably more difficult to be sub 3%. Probably more difficult to be close to the 2% inflation target that the Fed keeps talking about, right? So we are seeing an uptick in inflation. We are seeing a weakening in the labor market. The Fed has pivoted monetary policy wise to focus on the labor market for now. Um, I don't know. I think if an inflation of 3.1 doesn't necessarily break anything, but I mean, if we see 3.5 again, 4% again inflation, like that's going to be noticeable. So anyway, this is for months it was sideways, but it's been ticking higher, and I think it's probably a good thing we're not seeing inflation data today, just because the worry is okay. We have a softer labor market, AI disruption. You throw inflation on top of that. What's the Fed supposed to do? It's not making their job any easier, that's for sure. Uh, well, yeah, I trying to think. I literally talked about that. Um, it wasn't like focus on Burry. I'm seeing Bodine's comment there. Um, I think that look, Michael Burry is a very smart guy, and I do know that it's not an emotional decision, but I also think that if it's an idea that he has based on math, based on reality, that is the famous saying: markets can remain irrational longer than traders can remain solvent. Um, I don't know the exact podcast. Let me see if I can find it. This is a good listen. Let me go youtube.com. Let's go Market Huddle. It's either the or Market Huddle. Yeah. All right, let's go YouTube. So Market Huddle, a couple of guys that I really like. They do a good podcast. They've been doing it now for a few years. But they had I think two guys that were in the offices involved in the Big Short. And let me see where they're. I could probably recognize the episode. It's this one here. Vincent Daniel. If anybody's a fan of the Big Short movie, Vincent Daniel Porter Collins, you would recognize those names. Vincent was like in the movie. It was Eisman's right hand man. Like so, Steve Carell. He played. I think it's Eisner. Anyway, the guy that was in Succession as one of the sons in Succession, that movie, he was Vincent. So anyway, this is a great episode. Um, if you want to give it a listen, uh, I'm pulling this back in because what they're talking about is how many people they knew in addition to them that were short in 2006, 2007, 2008, but they were short and they didn't survive. So even Burry, who did end up coming out of the Big Short very profitable with Sign Capital Management, it's like that narrative of being, I've got to be right. I'm going to be right. I know I'm right. But if the timing is a year or two later, now, granted, he didn't close the hedge fund. He didn't close the hedge fund. He probably still has, 100 some million or less than 100 million, so doesn't have to report anymore. I don't think you just throw in the towel and say, I'm no longer managing $100 million. But anyway, it doesn't matter. I know it's big news. I will say that being short the market can be a painful ride, period. Especially if it's, majority where your capital is and watching this market just continue to melt up through what you think and you've, mathematically calculated. The probabilities say it's like, it doesn't matter. I just think you have to, I don't know. It's nuts to me. Like I couldn't see myself all in on anything. And I get it. Like the all in is, if you're right, it's asymmetrical. But if you're wrong, you're just you're watching your capital just go away, little by little. And that's what a melt up looks like. So yeah, deregister with SEC. Well, when you're under 100 million, you don't have to report. So that's the make or break on the SEC is if you're over 100 million, you have to report the SEC, be SEC registered. When you're under 100 million, you don't. You can still have a fund. He could flip it to a family office. I mean, there's all sorts of ways that I'm sure Michael Burry's not going away, but he may not pop up in the news as much anymore. So anyway, if anybody wants to give that a listen, I thought that was a pretty good one. Pretty interesting stuff. So share. Big Short. So that's a good episode. I just remember that one specifically because of Michael Burry, and they talk about like three or four other offices that were all in the same position. Like they they knew about the housing market, they knew about the bubble, um, and they knew about the financial troubles, but they didn't survive long enough. So I think some of them really had to wait it out like 2+ years, and it really just came back to risk management. So anyway, all right. Enjoy. Inflation higher. Let's get some numbers. VIX at 18.16. We calculated 18.2, I think, earlier, 18.25. So we'll see. 18.16. I'll keep it 1.13, 1.14. Recenter the VIX box on my daily profit play indicator. We're likely going to get a gap lower. It's 0.4% on futures. So I will roughly calculate. Let's say we go 0.4% lower. Okay, let's say we open up around 68.23, give or take. I'll take that level and I'll go 1.14. So about 67.50 to 67.45 potential bottom or low based on VIX at 18.16. Okay, and that's plus gap. That's plus the gap lower. So again, pretty conservative, but to be safe, if we have a decent sized gap like 0.2, 0.3 or bigger, I take the gap plus the VIX, project that low. Could it still be exceeded? Sure, in a crazy day. Like I'd say the only time this would maybe be tested would be like a Jackson Hole type day, some crazy surprise day, a 3 standard deviation sell-off type day. So, but we would know that, hey, don't call the bottom if the VIX is just ripping to the upside, right? Okay, on the upside, take the close, go up 1.14, pretty safe here around 69.25. So 6925, 6930, potential top. VIX at 18.16. So that's not including the gap lower. Okay. If you take the gap, which would be 0.4%, then you take your VIX box that pushes us to potentially a 6,900, which would be a difficult level to get to. It could get there, but more difficult level to reach there based on the VIX measurement. Okay, so these are my safest levels. If you're looking to, sell premium up here, that's a pretty safe top. Sell premium down here, as long as the VIX is somewhat contained and not going through, the 20 handle. This should be a pretty safe low as well. Very good. Okay. How many of you took a look at my Telegram video yesterday? So I just the reason I do this is TradeView picks me sometimes as a top editor's picks when my videos go out. So if I don't have a live session for YouTube, then I will throw a video together on TradingView. I do it with their platform, and they always tell me if you want to be editor's picks, like just use our platform. You can flip back and forth between your own charts, but don't show third party stuff. So yes, I wanted to talk about inflation. I want to talk about the news, but I'll share that on my YouTube stuff versus TradingView. Anyway, point is, throw a video out there. Did all currencies, gold, silver, Bitcoin, where we're at for the markets. Looking at the backside of this trend line, this goes all the way back to May of this year. Okay. So technically speaking, this low, this low, this low, this low, that was a fake out. These lows, I want you to pay attention to this trend line. Okay. This trend line that I've drawn that's connected all the way back from the May lows. Look at how price, even though we broke it, we gravitate towards it. Okay. Even though we broke it, we gravitate towards it. So trend lines aren't perfect all the time. But I think what right now we're at a really like critical spot because this area, if the bears take this back over, let's say we fill this gap here, let's find that price point. If we fill this gap around 67.30, okay, if we fill this gap around 67.30, if the bulls defend that level, I think we're good to continue to march towards all-time highs. If the bears reclaim and exceed this level, we may be sliding back towards those lows. That was our 4+% correction for that early November slide. This is our October 10th single day sell-off point. So, I mean, technically, I think the market can slide pretty aggressively if it's going to take out 67.30 and take out that recent low. If we watch day to day, that's a good thing about being here every single day, is from a technical standpoint, if we have support and positive gamma day to day, we're just looking for the market, just a little bit of waves, but still trying to grind higher. Okay. If we're going to roll over either, high to low, lower high, lower low, that does make me concerned if we take out that level that we continue. And that might be to the tune of, 8 to 10% before the market rallies. Everything this year seasonality wise pretty much got shifted, right? The typical like August seasonality, September seasonality, even October, like there was no weakness in any of those months. If you look at the monthly candle, I thought this was crazy. Look at how this price action has played out in 2025. Literally anything down has been just a rip. So we had a, down February, March, April. All this is a giant wick to the south. Look at what we've seen so far in November. A giant wick to the south. Okay. Eventually, when you're at a, topping type candle on a monthly time frame at the all-time highs, I mean, people will call this a gravestone doji or some type of indecision candle, and maybe, right? But I think there's a lot more to it than just assuming that one candle is going to be the top of the market. But day by day, control your risk, and we'll figure out how to navigate and survive it. Okay. All right. Open bell in about 5 minutes. So we're plus minus on the day. Surprised the Ivy rank. Oh, that's about right, I guess. So SPX expecting about a 35 to 36 point move on the day. Let's take a look at our deltas when we open up this morning. Treasury yields rise. Okay, we'll take a look at that one. Set to open lower markets away after government reopening. Futures muted. Well, they are not when they're down 0.4%. Let's take a look at US 10-year. Yep. So we're up another like 4 to 5 basis points on US 10-year. Probability of the Fed cutting rates still 60%, I believe. Oh boy. Well, now we have like a coin toss in December. I think there is pressure to get the Fed to cut again in December. I don't know. December looks, if the Fed doesn't cut, I think the market's going to be volatile. The market, like the market had to price in these rate cuts. So if they take that away in December, whatever, you can blame the Fed, but it's as I don't know. We don't know how close we are to actually having like really ugly inflation again. You know, it's a delicate market. So I think we're holding on to optimism and ignoring some of the risks underneath the hood. But this was like high 60s. Now it's 53. So since we're going into December, which isn't that far away, I know it's technically about a month away, but this Fed decision at 50-50 does not make it easy to kind of position for. Okay. We're not for a cut. Yeah. Like already talking out to December or saying they didn't want to cut in October. We'll see. I mean, there's a difference between the academic Fed and the like market Fed. I mean, if you look at market conditions, and that's one thing that look markets at the end of the day, markets will kind of force the Fed's hands. If we see yields going higher, Fed's probably going to have to pause, right? The Fed has cut 1.5% since September 2024, and yields are not lower, right? So it's strictly controlling the short end of the curve. Um, yeah, it's a battle. It's a battle between markets making policy decisions versus academics. So, I mean, Fed smart people, it's full of PhDs, but clearly what has happened these last 10, 15, 20 years, Fed has been responsible from some of the biggest stretches in wealth inequality from what the market's done and how the Fed is forced to come in and backstop things or has come in to backstop things. Um, it's just created wider and wider disparity. So I think now that the retail crowd is almost like in tune with that, that's why the buy the dip has been such a popular mantra for the retail crowd. I think that the issue is like the retail crowd generally can't hang on to, buy the dip when the market's down more than 20%. The retail crowd buys the dip and they're tapped out. They have no more liquidity. I'm generalizing, but that's kind of how it is they don't have the discipline to, ride a market down 20, 30, 40, 50% and still buy, have assets to buy. So I'm not saying that's us. I'm just saying like the general retail crowd is highly levered, all in, and the buy the dip is like every 1 to 3% market is seeing the retail crowd aggressively buying. So all right, we're opening up lower. Futures down 0.4%. Let's see where the market's at when this feed pops up. Okay, we opened up 68.20. So about a 0.43% gap lower. Let's take that open plus our VIX, 18.1 VIX. So 18.1. So we're looking at a 1.13 move. Take the open. 1.1. So about 60. Yeah, about 67.45. Okay, let's have a look at our levels. Plus or minus 33 on the day. I need my deltas to shift a little bit. This shows the 10 delta inside the expected move. I need that to shift a little bit. SPX, I got a 60-cent fill. That would have been a waterfall pending order. Let's go SPX filled. I don't know if we actually put this one in the tracker for waterfall income, but I will. So this was a 61. Let's see if I put this one in here. 116. $61.50 and 40. Okay, so that one for December 31st is open. January 16th, 61.50, 40, 30, and 10. Okay, so I'm going to put this in as a fresh trade that just got filled. So this now goes to a trade 125 for waterfall income. My delta should have shifted on daily profit play. I'll get my trade in here. So 70, 75. Let's go some real-time gamma here. So 10 delta, 67.50. Okay, I'm going to try to get $1 out of this trade with 10 deltas. $11.13. This trade got filled. I'll post this for waterfall income. 116 expiration. Full income. Strategy 2. Pending order. Now filled. Uh, 6150 to 6130. Okay, trades in. Here's real-time gamma. So gapping lower, 50% ATR around 68.12, positive negative gamma, pivot around 68.40. See if we can get filled. Working shows 85 cents. I'd like $1. We push a little bit lower. A little bit lower, this probably gets filled. Okay, we'll see. I'm going to throw in, so I'll keep an eye on the VIX today. I'm going to look at a butterfly, a pretty tight risk butterfly spread around the 45 handle. So on the put side, flip the option chain. Let's go put side. We're doing 67.45 or so. So I will do a 50, 40, 50 and 45 and 35. Set this up for a broken wing. It's offering 25 cents. If this fills for $1, I'd actually be pretty happy with that. If it's 50 cents in a broken wing for an intraday is pretty good, but $1 is, I'll take that trade. I'm risking 400 to make 100, and I also have a profit trap on top of that. So $1 fill is a great broken wing butterfly. 50 cents is acceptable. I'm risking 450 to make 50, but also gives me that profit trap. So let's see if we can get $1 out of this. And then on the upside, with that gap, we are pushing a little bit lower. I think our daily profit play is going to get filled this morning. Hope that it does. If we push a little bit lower, hopefully that 10 delta will get pushed. Okay, keep an eye on the VIX. I mean, it might be easier to, call the top today versus the bottom, to be honest, depending on what the VIX does. So I think I'll be safe and I'm not going to call the bottom. Let's see if we get filled on daily profit play. Maybe the market has a difficult time getting back up based on current open. Let's go ADR as well. ADR is around 60 points. So open here. I mean, 68.81. Being pretty conservative with my VIX today, but I'll still use it. So 1 point. I think 69 would be a difficult hit today for the Bulls. I'm going to throw in 2 broken wing butterflies. 69. MDT got filled for a winner. That's pinch point, I believe. MDT just closed out for a winner. 187. So that is 6-2, a 50% winner. Automatically hit. Sweet. Another winner for pinch point. Love it. 69 for $1 credit. Order is invalid. What? $69, 05, 15. There we go. Okay, so pending order at 6,900. And then my 2530. Again, difficult to get there today, but I'm going to go 25 by 30. 25, 30, 40. All right, a couple penny broken wings that may not get filled. I'm surprised that our daily profit play isn't getting filled yet. We just had price drop another, 8 to 10 points. We were trading at like 90 cents. It's trading for 80 cents right now. We'll see. Okay, let me put the daily profit play stuff. It'll be in Telegram for members. So if you're a daily profit play member for the alerts, trades are coming. I'll throw in the butterfly spreads here for Zoom if you're interested. DPP trade, SPX. We're trading at 68.06. I'm going down pretty low. I mean, 10 delta is like pretty low, but let's see what it looks like. 68.70. Okay, we'll see if that gets filled. So the deltas I'm looking for, put side, are now trading for like a 12 to 13 delta. I still like the trade. Okay, so I have a top calling the top. I'll put this in Zoom chat for everybody. SPX 1113 expiration. The safest one is going to be this trade, 69.25. It's unlikely going to get filled, but dollar credit pending. Or SPX. It could be an and/or, but 1113 expiration by the 69, 6905, 6915, dollar credit pending. All right, there's 2 trades right there for the top. Obviously, the higher strikes are the safest. The one that is 6,900 is based on the current price action gap. So we gapped lower, measure your VIX box. That should be the top for the day. ADR is only 60 points. We really shouldn't be seeing much more than that. The bottom, I don't want to call the bottom with the VIX going up. VIX is at 1851. That's a little bit higher. 18.51. So 1.15, 1.16 move. To be safe, take this. Measure out like 1.15, 1.16. So that puts us around 67.40 or so. I mean, I do think the trade is safe. But if I'm going to take that trade, I want it to be a bigger credit than $1. I think if I'm going to take the trade, give me a 250 risk. But I already have my put side there for the daily profit play. So if I try to broken wing butterfly that thing, look for a $2 fill, trying to call the bottom, get a profit trap. We'll see. So I'm going to hang out and wait. We're getting the daily profit play to show about 75 to 80 cents credit. I'm still asking for $1. Okay, trades are in. We've got some broken butterflies in the Zoom chat. We got a pending order in for daily profit play alerts. Pinch Point just had a winner on MDT. Let me put that in Telegram. Pinch Point. That is trade number 60. MDT. Entry $1.25. Close $1.87 credit. 50% take profit hit. Love it when that happens. That's 37 winners, 84%. Automatic take profit. Feels pretty good. Okay. Price action's pretty directional. Come on, daily profit play. You look at a reverse iron condor. That would be I did 90 by 15. That's 25 wide. Gosh, it's just such a big drop. 20 wide dead zone, plus or minus 35 in the day. VIX is elevated. You're only getting 560, 565. Just not a great trade. So, yeah, reverses are just tough to get the $6 credit unless you're going to go wider. This is 25 wide. It says, you get 590 to $6. That's a pretty wide dead zone. So I'll pass. I'll just see if we get fill in daily profit play. How would I hedge? The broken wing butterflies are pretty good hedge. It's not really a hedge. It's more of a defense. A hedge is like I take the trade and I put another trade in to hedge against it, like automatically. My thought on daily profit play is I put the daily profit play in expecting it to win, but I have some defense levels at the tops and the bottoms. So that's my risk management. Because if you get too active during a daily profit play in a 0-day environment, like the trade I showed you yesterday, remember me talking about doing like a, at the money credit spread and then doing an out of the money long put for a hedge. Unless you are willing to be happy taking like a 10% profit every day, you didn't make any money. So a 0 day is just, it's so difficult to hedge, and you're essentially just, I don't know, you're generally overpaying for premium in a 0 day environment, which is why I'm typically a seller of options during 0 day. So anyway, like I said, I will defend versus hedge. Daily profit play is expected to be a winner. We've had 31. So our last 34 trades, we have 31 winners out of our last 34 trades. We're at a 91.1%, 91.2% win rate the last 34 trades. I mean, we're still averaging 90% across the board. It's like 89.5% for 500 some trades. We win a lot of our daily profit plays. So, what I do it's not hedging. What I do is make sure that I'm very particular about risk management. For the service having, over 1,000 members now, I think going five wide is totally good for the service. It keeps risk management very small. And it's also easy to defend. If my max risk is $4 on the day, it's easy to defend that versus if I'm 10 wide, 15 wide, 20 wide. If I lose on the day, it's like I'm risking $1,000+ That's a little bit more difficult to get back unless I'm going to double and triple down on my risk, which I think that's silly. Intraday, that's a lot of risk. Okay. So the defense trades are what I put in for the chat. Looking at some of the broken wing butterflies or selling some credit spreads way out of the money. Be careful on the credit spreads way out of the money because again, those typically take on more risk. The broken wing butterfly is a good defense trade because like my broken wing butterfly, if I risk 400, okay, likely winner would be $1. And I also have a $5 profit trap for a $6 potential max winner. So this is a broken wing butterfly structure. Getting $1 credit is actually pretty solid. If I get $1.50 to $2 credit, take this down. So this would be broken wing butterfly. So if I did a broken wing butterfly, broken wing butterfly setup for $1 credit, I'd have $4 risk. The likely profit would be I'm putting that at a high probability top or bottom. I'd expect to make the dollar on the trade. I also have a profit trap in case price is going to test that high or low. Okay. So if this gets bigger, let's say that I do a broken wing butterfly setup for $2. And if that gets filled, that risk is now down to $3. The likely winner is $2 and the $5 profit trap, which would give me a potential $7 max winner. So very quickly you go from, what has like a broken wing butterfly does have risk, right? It's essentially the call, the credit spread side of the broken wing butterfly is where all of your risk is at. But if you take that trade with a reasonable credit, you can control the risk pretty nicely and still give yourself like a top or bottom to call as well as a credit that you're, fairly happy with. Okay. So that's oftentimes what I like to use. And we'll see if, we've pushed directionally a little bit this morning. Opening up here, markets pushed down about 27 points, plus or minus was 30, 37 on the day, 35, 36, 37 on the day. VIX is up. VIX is at 18.57. Markets wise are down. We got NASDAQ down over 1%. There's been some tech lagging, that's for sure. XLK is down 1.25%. Nothing really gets bad here, right? If we're talking, oh my gosh, this is getting so bad, Chris. Well, we'd have to be below this, correction low. If we take out this correction low, there's your October 10th candle. If we're taking out those levels, then sure, things are rolling over a little bit. You'd have a major tech rotation where tech is going to be volatile. Tech is going to be red. It's going to drag the markets on with it. Keep in mind, we also have NVIDIA earnings next week, which I think is going to be a lot of this. This is probably just noise, to be honest. I think we have just a noisy area where right now a lot can happen inside of this and it doesn't really mean anything. If the market's going to, cling to hope and animal spirits to the end of the year, maybe it's noisy, but maybe it finds a way to just maintain stability and try to get back to highs for the end of the year. Okay. Is NVIDIA earnings a catalyst for that next week? Possibly. Do we keep like suppressing news and data where we have no idea, like what is our next non-farm payroll number? Are they going to wait until the first week of December to give us non-farm payroll? What about our next round of inflation? We don't have CPI, PPI today or this week. So we don't know. All right. Any questions on that? So watching XLK, watching Mags. Mags is down. It's going to bring the market with it. It's 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 a lot of market cap. You go to the market cap indicator it's S5FI. The S&P now has market breadth back above where about 51.6%. Now this could quickly fall back down, and maybe we have a bunch of stocks in this area where it means we're about, kind of 50-50. 50% of stocks at the 50-day or above, 50%, below. And then it's about the 200-day moving average, which I think is low 50s right now. 57% of stocks in the S&P above the 200-day moving average. The NASDAQ market breadth has decreased quite a bit. We're at 50% above the 50-day in the NASDAQ, and then 56% above the 200-day. So NASDAQ is showing more signs of like an indecision. We had a nice little pop in market breadth here from our bottom on the, this would have been Friday the 3rd, or whenever that Friday was. Friday was the 7th. So we started to see a little bit of market breadth, and it really kicked in on the 7th last week. All right. Anyway, back to it. Okay. So open, candle, gamma levels so far seems to be pretty contained. Remember that positive negative gamma, 68.40, 68.45. Okay. What I don't show for the day is I don't show any more gamma to the downside, which means it is vulnerable. If we break lower, all of that is vulnerable. So I want to do one thing here. Let me switch over my real time. This is dynamic trend. I'm going to switch this to, right now, this is exclusively focused on 0 DT flows. And if I update this, I know today's Thursday, but if I go to this, my indicator here, gamma squeeze index, and I go from ultra short term, which is a 0-day, and then I do a short term, that would pull in from flows from today and tomorrow. So I'll apply that and see if there's anything lower. So right now, going into tomorrow's expiration, 6,800 is a pretty key spot, and the bears are at it right now. So 6,800 would be pretty key support, and then 6,850 looks like price could get there. It does make me curious, like doing a 60. I mean, this is a total guess, but if I did a 6,850 for tomorrow, or I did a 6,800 for tomorrow, I want to build out something really quickly on option strat and see what that looks like. Not option slam, that's earnings. I'll come back to that later. So let's build out a iron fly for tomorrow, and maybe look at a pin price around 6,800 and go 20 wide. So call, put. I mean, so if we're at 6,800, that's a pretty decent looking trade. It's slippery. I'm just curious. Let's go 6,800. Let me see what a 6,850 looks like for tomorrow. 6,850, 50, 20 wide. So risk about 260 on this trade. Want to tighten that up a little bit. Risk 150 on that trade. So if we get back up to gap fill tomorrow, that's a pretty tight risk. 27, I mean, you go 45. I risk 3. I got to go a little tighter. Risk 180. So I'll go out of the money. I risk less. So that's 15 wide with a 6,850. I don't know. That's a maybe. So the nice thing about the iron fly would be the trap is pretty big. So even though it's trapped like this, if I build the trade out, the P&L looks more like this. I have a much wider area than 15 points. So this is my center price, 15 points down, 15 points up. That's exactly, 30 points wide. But the reality is during the build of this trade, you have some profit potential here. Let me get this. I'll try it again. So if I build this trade out, right now we're trading around 68.12. Okay. If we get up to my build this out to 68.50. Oops, the heck. So 68.50. Then it went 15. Something like that. So if we came to hit that, let's go to end of the day today. So if we go to 4 p.m. today, that doesn't get too exciting. Yeah, it's like let's say we're at our profit trap by the end of the day, we're up $30. The magic would be if we open there tomorrow morning, there's your 9:30 opening bell and prices within that. I mean, that's the trade you want, right? You're risking 150 and all of a sudden you're up 140, 150 in this profit trap tomorrow. So you still have some profit within about 68.15 to 68, 70, 60. I mean, that's a good winner. But we got to believe we got to head higher. I don't know. It's just a trade. I'll pass on it right now. So I put that together because right now, if we break the lows, there's not much below it, which makes me think that price, even with today, is somewhat contained to maybe like the 6,800 holding is today's support, and we just kind of dance around, maybe looking to come back and fill today's gap, whether that's later today or tomorrow. Okay. What if we take the iron condor for tomorrow expiration, but sell it today? Well, if you look at it from a delta standpoint, Omar, you should just be able to go out a little bit farther. The expected move for tomorrow was like 50 plus points. So I'm going to go back into ultra short term here. So let's just focus on today's flow. So there's my flow today. If you did an iron condor for tomorrow, so take a look at your deltas. So go into Friday's expiration. Your call side, you're looking at like 60, 68.85, 68.90. Okay. So what happens if you took this trade tomorrow, any type of overnight gap, and again, in a 1 day or a 0 day environment, this should be calculated in, but we don't know that. One thing that is very disruptive is day to day. If you go for a, let's say we have like another 0.2 to 0.4% gap, higher or lower, it's going to test one of these levels, So I mean, I like the trade, like an 11 delta at the call side highs, like 68.85. Okay, that'd be pretty difficult to get to. 68.85 is way up here, right? Like today, I'd say there's probably no chance it's going to get there. But if we rally back here and fill this gap and we come into trading tomorrow, it's very gettable tomorrow. So I don't know. I mean, I think I'll just tackle the trade tomorrow as is. But I'm curious how far like up we can go and how far down we can go. Let's try the 10 delta here. 10 delta on the put side is 67.05. I mean, it's the same trade. It's like I get the trade, put it in for $1 pending, take 10 deltas. Like, does it fill? Yeah, sure, maybe. But given the VIX calculation, given the ADR, today and tomorrow, like it's very gettable, And the point is I'm trying to put trades together where like today, I'm pretty confident that price isn't going to hit my highs or lows or get through them based on the calculations I've done with the current VIX, our VIX box, our daily profit play, our ADRs, like all these things we do every single day. I think price is going to be relatively, manageable today. We shouldn't go too high because we've already calculated. But going out tomorrow, I don't know what a gap's going to look like tomorrow if we have one. So it makes it more challenging to go, 1 day is fine. It's still, gamma sensitive and a gap can disrupt it. So what you're banking on obviously is like market's going to find a way to gap higher. but today we got 0.4% lower. So anyway, point is, I'll pass. I'll pass on like the butterfly for tomorrow. I'll pass on an iron condor for tomorrow. Um, I'll just tackle the day fresh. So what I'd like to see is if we get another kind of retest of the lows, maybe going a little bit lower. I mean, even this 100% ATR. Okay, if we get down to fresh lows and hit this 100% ATR, I mean, from the close yesterday, 51 to 70. I mean, we're talking an 80-point move from yesterday's close from a open at 26. I mean, that's still 50 points. Market makers expected 35 today. So I think that's enough pressure to get us filled for a daily profit play. But if it's pushing down here and slow and steady, or stalling or going back up, then our daily profit play gets filled for profit. So part of me is encouraging that the market drops a little bit lower. Let's see if it drops a little bit lower. Let's get our put side offering up the profit that we want, or the credit that we want on the daily profit play. Let's get our fill for $1 and see if we can manage a very simple, like 30, 40, 50 cents out of it. So I had 2 contracts in yesterday and closed one at 50 cents and let the other one go until 25 cents. It would have finished at a full winner, but that was 2 nice wins yesterday. Okay. Terry says, I think the market has sensed we're not. I mean, you don't know that, Terry, because I think we are getting the cut in December. If we don't get the cut, and I say that I think we are getting the cut because unless the Fed wants to, kind of support a pretty ugly sell-off in December, I think if they don't cut, the market's going to act very poorly for that. It might still get picked up because they might turn around and cut in January, which is so stupid. So I just think, I mean, I don't know. It's like they can't be that blind to what is actually happening. Yes, the labor market is down. I think a lot of the labor market stalling has been because of our immigration policies. Now we're talking about AI disruption, or a lot of things are being linked to AI disruption. AI is just getting started. I'm literally attending a 3-day boot camp. I did it last week to kind of preview. I'm doing one of 5 additional module days, and one of them starts today. I mean, it's so new right now that it'd be crazy for the market to price in recession. Nobody's gonna have jobs, and they do that now. It's like the market's usually 6 to 8 months forward thinking, not 5 years, not 3 years, not 2 years. It's 6 to 8 months forward thinking. So, I mean, yes, the Fed probabilities have come down from 70 plus, 80 plus now to 55, 56%. This will change over the course of the next couple of weeks as we get closer to this date. This tool is rarely wrong. It's just it makes it a little cloudier when we're only within about 5 or 10% of either a pause or a cut. So we'll see. One thing that and I don't know, it's like if the Fed doesn't cut, what happens to the yields? If they don't cut, maybe yields go down a little bit. But we take it day by day. Okay. Yeah, but they have data, man. I mean, the Fed can't be like, oh, we don't have any CPI data. We have no idea what we're doing. It's like there are other ways to calculate inflation. I mean, we're building inflation data that excludes what people care about. You exclude food, you exclude energy, you exclude rent prices, home prices, all that stuff is so much weighted into real inflation. And you're just like, we'll just take that away because shelter is lagging. Food and energy, because I have no idea why they'd exclude food and energy for core CPI. That's insane. That's literally what is probably breaking the bank for most people. Your home, your car, your food. That has to be some of the biggest expenses for most people in every household. So they're not shooting blind. They're just, I don't know, refusing to look for other data. I don't think the Fed is stupid. They are some of the smartest people in the world, economist wise, but there's a difference between academic smart and, Wall Street smart, I guess. And sometimes there's a disconnect that can lead to some pretty wild things in the markets. But we'll see. But, in all honesty, it's like the Fed's more or less been neutered in 2025. The Fed's being backed into a corner. There's a ton of political pressure. They've been criticized heavily especially, I mean, Powell's been criticized a lot, but it doesn't help to have all of the political pressure on top of that, where, the Fed's trying to not look political, yet they are. Um, you have a, stacking of the Fed, which is going to basically appease the administration. So you're backing the Fed into a corner. You've got high inflation, a struggling labor market right now. I mean, that's not a good problem to have. And the issue is, we're rolling off the balance sheets. We're basically the QT is ending, and the next round is not going to be more tightening. It's going to be more easing. So in some way, shape, or form, we're probably going to have a Fed balance sheet expansion, and that would likely lead to more liquidity into the system. So, look, I have I'm doing a session next week, and I think we've talked about this before, but paradigm A, paradigm B. Actually, I'll just find the slide for this. I built a deck on this. Give me 1 second. I'll find it. Okay. So these are some of the things I'm talking about. Frothy evaluations, AI hype, Trump administration, paradigm A, B, C, D. I'm going to get to that slide. This is what we are dealing with. Okay. Biden administration was a K-shaped recovery because we started aggressive fiscal dominance under the Biden administration to basically prop asset prices up. I see a K-shaped recovery is because, yes, money went to households over 2020, 2021 with those stimulus checks. 12% of that made it back into the system. We had $800 billion in handouts that over $100 billion of that went into the markets. So we had added liquidity. We added $6 trillion and threw it at the problem. So those that had assets that see assets appreciate, I mean, home prices have doubled in the last 4 years, 5 years. That's insane. That's not what the housing market should be doing. Housing shouldn't be treated like this as a, short-term investment, but it happened. So, you have things that look like this. Your asset prices go up, and those that have no asset prices just get further and further behind because we have loss of purchasing power and a debasing of our currency, which is nothing new. It's nothing new, but it's just like a moment in time where you can just sense the rift, and then the rift just gets bigger. So COVID recovery, the rift got bigger. Assets get up, and those that don't have assets, it's like economy falls while the economy rips. And it's, they keep using the phrase bifurcated markets, right? Okay. Trump and austerity. Well, we thought we were going to come into this 2025 administration with austerity. What happened? We pretty much broke the bond market. The bond market flinched. We pivoted hard, and now we're going to go to paradigm C. And this is where we're currently at. Everything is okay. We're not doing austerity. Yes, we've had the longest government shutdown in history. Maybe we've trimmed some things. I don't know if it's going to mean to or lead to, leaner, meaner government. Probably not. But we're trying to now convince the world that we're going to grow our way out of a $38 trillion debt problem. We're trying to convince the world that tariffs are going to give us so much revenue that we can decrease our deficits. I find that hard to believe. So what we are realizing is PMIs are rising globally, which means that bond yields globally are rising. Okay, which makes everything stickier for rate cuts because what we're controlling is not the long end of the curve, but the short end. So assets are rising. We're at all-time highs. E-shaped recovery, the whole point of this grow, baby, grow is that, okay, the K has already been started. But if you can keep the K going, but you pivot to an E, everyone that's been falling behind, you're trying to give some help to the bottom. Maybe. That's a big maybe. Because if this fails, if growth fails, then growth stalls and it fails. And then the thing we're left with is we have to now print and stimulus and ease our way through it. And what is stupid is since 2008, we have the Fed and the government working so hard to just prevent a recession. That's why we have bubbles. That's why it seems like bubbles and busts and bubbles and busts, and volatility is insane because we don't just let a recession happen. We are like manufacturing recoveries and forcing our way through things. We are just keeping the plane floating. But if we get into stall mode, I mean, somebody's trying to come in with emergency gas to keep it flying. But if we go into stall mode and then we start to decline, it's like there's a lot of room to go down to the ground. And that's what we don't know how ugly this thing gets. So there is a lot of uncertainty. I mean, I've never thought of a current environment where the left side, like the risk that we'd have to deal with. So let's say you've got your distribution curve, okay, the left side or the right side. And I would put this easily at like 50%. I think the market could go 50% higher or 50% lower and say that that's an actual like logical guess over the next couple of years. You know, and I've never been in an environment thinking like that's where we have to be. Like something now again, I think the right just go nowhere. And nothing good happens, and everyone's like, "Why isn't the market going up to the moon?" And nothing bad happens. This market still stays like higher and elevated through this wall of worry, and that's trading. Tail or a nothing burger. Guess what? We got to trade it. Narrative, you can be wrong, and I'd rather just make money. I don't care if I'm wrong, but I don't want to lose a lot of money. I don't, need to be right. I just want to make money. There's ways to do that. Okay. Yeah, that's a maybe. Food matters for retirees. We're eliminating it, impacting. Yeah. Also, Don, to your point of GDP at 125. Yeah, but you've got Japan at 200+%. You've got other countries at 150, 200% GDP to debt. I mean, the fact that Japan can operate at like 220, 230 debt to GDP. I mean, the U.S. has apparently a lot of runway. Maybe. I know that empires have fallen, according to Ray Dalio. Empires have fallen at 120% debt to GDP. I get it. Okay. The issue is, look, if the dollar, and this is also like a kind of counterintuitive trade for the year. I think if the dollar gets more strength than people think and people realize, everyone looks at this chart and they're like, the dollar's down, the dollar's down. Oh my gosh, the dollar's going to fail. Don't be surprised if this thing doesn't fail. I wouldn't be terribly shocked to see the dollar honestly be bullish. I think one of the more crowded trades is everyone thinks the dollar is going to go down. And this is a big if we're going to see risk off trading. If we're going to see risk off trading, in my opinion, is risk off meaning dollar strength, risk off meaning maybe the Japanese yen gets stronger as well. But I mean, I think this trade could be maybe maybe some type of channel where we see a stronger dollar. Maybe it's just a range. I have no idea. Like it's such a big guess. Now, I would say that if the dollar got weaker, I mean, if the dollar was weaker, everyone's like death of the dollar, blah, blah, blah. I would have been long the dollar. If it came down to these levels, since we haven't seen in the early 2020s, I'd be long the dollar at the 90 handle or 85 handle because technically it's overcooked. But if we go back up right now, that takes this crowded dollar short and starts to give it a relief rally, starts to squeeze it higher. My concern is that type of move with a risk off tone is going to be, getting people in trouble because everyone is so short the dollar and so long assets, and it just flips into a risk off environment. Right. And again, this is a big move. This is a big move. And then somewhere in the middle, there might be a reality. Maybe this is the new norm for the dollar. Like heavily manipulated, super low volatility in the currency markets. I've seen it. I've traded some of my best years in the currency markets were crazy low volatility and super efficient markets. I made a lot of money. In fact, it's like a year to date, that was one of my best years I've ever had. It was 2012, 2013, 2014. That 3-year window was like almost a 300% gain for me. But then in 2014, things blew out and we saw a ton of volatility. And all of a sudden, what I thought I had were perfect strategies that were like, oh man, I'm in a 20% drawdown now. Let me figure that crap out. So markets change. Up, down, sideways. Bulls and bears make money. Pigs get slaughtered. These are sayings for a reason. They're true. So I keep going back to it. All matters about surviving. There's a lot of ways to make money when you can show up and trade the next day, and show up and trade the next day and the next day, and you're here next year and you're here next year. It's like I think the harder we work to keep our risk under control, the better off we're going to be in the long run, and the more opportunities we'll see that are right there for us. And that's a lot nicer to know that you've got profit probabilities and an environment that can be very lucrative and profitable versus you got to be right. You know, I like winning trades, but for me to have this big bold prediction, it doesn't do me any good to go all in and think like this is it. This is it. Look, I that's why I'm all the more impressed with a Stanley Druckenmiller. That is, put all your eggs in one basket, watch the basket closely. Part of me wants to do that, right? Part of me wants to be, all in gold. I think if there's a safe trade over the next 5 or 10 years, it's probably higher gold. But does that mean we can't have a 20, 30% correction in gold? Unless you're properly hedged or properly collared, it's like, I don't want to sit and make nothing and say like, oh, gold's going to be a good trade. Trust me. It's like, okay, but how am I making money through this crap? If we have a 20% correction in gold, how do you make money? I mean, you just lower your cost basis, but you're not necessarily making money. So anyway, a lot of stuff. And, if this is a 24-hour market, this is the crap that keeps me up at night. But fortunately, I can show up day to day and, take trades and focus on an opening closing bell. And it seems a little bit more like a work, like a job. When I was running a currency fund for 24 hours a day, stuff gets stressful. But opening closing bell is not a big deal. All right. Back to some real-time stuff. We saw a nice little rally off that 6,800 low. We're right back where we started the day. Do we get up to the positive negative gamma pivot? Possibly. Let me see where our levels were for, I think we did 68.77. Okay, so this is still trading for, well, that was our 85.90 cents this morning, trade for 55. So unless we see more direction one way or the other, maybe another no fill day, which is okay. I was hoping we would get a fill. We probably just had to go to a slightly higher delta. I was sticking to the 10s with the gaps and looking at some of those gamma levels. We'll see. Day's not done. I mean, 70, it's up here. That's a pretty big move on the day. Low at 95. If we went up 70, 80 points in the day, it's a big day. I mean, ADR is around 60. So just one step at a time. Intro buys bullish. Deanna, that's correct. Yep, that's correct. So practical options, quick guide, all four of those are right. Okay. Yep. All right, buddy. Let's switch gears. Let's see what happens if we get a trade filled for daily profit play. I've got a couple tops, bottoms. For defense trades, I got the daily profit play still pending. I think price could maybe surprise us with the open today. We opened at 26. We went down to 95, so we had about a 30-point move to the downside. Remember, the plus minus was 35. So just keep that in mind. We could have the open here. We saw a plus minus 35. This was a 30-point move. So we could go up here and have another, plus or minus from the open. We could have another plus or minus 20 to 30. And you're like, wow, what a volatile day. But market makers are like, ha, exactly what we wanted to see. So it might still be a very good day for market makers to win. They're usually good at their jobs. So, all right, we'll keep an eye on that. Waterfall income, we just had a trade fill today. So that gives us a couple more positions for The waterfall income portfolio took a trade today for 60 cents that just got filled. That trade is valid. And then I still have a pending order at 75 cents we took on Monday, still pending. If we slide a little bit lower, that trade probably gets filled in the next maybe, let's say we slide down to like, what are these recent lows? We slide down to like October 10th lows, like 6,600, maybe, or even go back down to retest the recent low that we had here on Friday the 7th. I think that trade gets filled. So a couple pending orders. We have 104 winners out of 111 trades. That's pretty good. Since we've been in the service together for just over a year, 93.6% of our trades have been winners. I'm super proud of that. We've traded through a lot of craziness and had a lot of profits to show for it, which I'm obviously stoked with. So, all right. Yep. We talked about that in the masterclass, Rob. So it's pretty easy to look at, how many contracts are needed. It's just do the math. So you know your risk. Again, to make that $1,000, remember, it's about risk. You're getting about 15 to 20% return on risk. So if you want to make $1,000, okay, you want to make 1,000, you got to risk 5.